It's the wick on the Tuesday candle that bothers me. You look at a standard crash, 2020, 2011, even the flash crashes in the equities markets, and usually there is a staggering, a bleeding out. Buyers step in, get crushed, price move lower, repeat. It's messy. But look at what just happened. Look at the 1-minute chart from Monday morning to Tuesday afternoon. It didn't bleed, it was decapitated. We saw a 30% drop in an asset class that is supposed to be the bedrock of stability, the hedge against the very chaos we're seeing in the bond market right now. 30% in hours. And then silence. The tape just stopped. Limit down. Lower circuit. If you were trying to get out, you know exactly what that felt like. You press the button and the terminal just stares back at you. Order rejected. Market halted. You're trapped in a burning building and the fire marshal has locked the doors from the outside because he says it's for your own safety. That's the official line anyway. Orderly liquidation. Market stability. But here is the part that keeps nagging at me. The part that doesn't fit the panic selling narrative the networks are pushing right now. If the market was frozen, if retail traders were locked out, if the funds were margin called and forced to liquidate at any price, who took the other side of that trade? Because for every seller, there has to be a buyer. That is the physics of the market. You can't sell into a void. Someone bought. And they didn't just buy a little. They bought everything. They bought with such aggression that the moment the circuit breaker lifted, the moment these safety mechanisms were turned off, the price didn't just stabilize. It ripped. It went vertical. We're talking a 10–12% move in the opposite direction almost instantly, a V-shape so sharp it looks like a glitch. That's not retail. That's not you or me deciding suddenly that silver's a bargain at $78. Retail is scared. Retail is looking at their account balance, seeing the red and vomiting. Retail is paralyzed. So who stepped in? Who had the capital, the courage, and more importantly, the permission to buy billions of dollars of notional silver contracts exactly at the moment the exchange made it most expensive to hold them? I've been tracking the volume data from the COMEX and the MCX, and there is a footprint there. It's faint, but it's heavy. It looks like an institutional transfer of inventory, not a crash, a transfer. They shook the tree. Hard, harder than I've seen in a decade, and a lot of people fell out, but the apples didn't hit the ground. Someone caught them. I want to walk you through the timeline of the last 48 hours minute by minute, because if you look closely at the margin notifications, specifically the one released by the CME on Sunday night, you start to realize this wasn't an accident. It wasn't a market panic, it was a mechanism. And if you don't understand how that mechanism works, you are going to get flushed again, because this wasn't the end of the volatility. I think this was just the clearing operation. They needed the seats empty before the real show started. Let's look at the numbers. You wake up Sunday evening. Maybe you're checking the futures open. Just a habit, right? And you see the notification. It's boring. It's buried in the usual exchange spam. Margin update. Most people delete it. They don't read the PDF. But if you open that document, specifically the one from the CME group effective for Monday morning, you saw the gun on the table. They raised maintenance margins, not by a tick, not by 5%. They hiked the requirement to hold a silver contract by nearly 36% overnight. Think about that. You're holding a position. You're comfortable. You've done your math. You have enough cash in the account to handle a normal swing. And then the exchange changes the rules of physics. Suddenly, your safe position is underwater, not because the price moved, but because the cost of admission just went up. That is a forced liquidation event. It has a smell. It's mechanical. It doesn't care about fundamentals. It doesn't care about industrial demand, or the solar panel shortage, or the deficit numbers we've been screaming about for 3 years. It is purely a liquidity extraction. And Monday morning, that's exactly what we thought. The price didn't just drift lower. It collapsed. We watched silver go from fighting at those highs, record highs, mind you, straight down the elevator shaft. We're talking about a drop that erased months of gains in hours, $121 an ounce, down to $78. But here is where the narrative breaks down. Here is the first contradiction that the news outlets are getting wrong. They're calling this a correction. They're saying the bubble burst. They're bringing on guests who say, see, silver is volatile. It's a bad asset. That is lazy analysis. If this were a true sentiment shift, if the market actually believed silver was worthless, you would see volume consistent with selling pressure all the way down. You would see buyers stepping away, letting the price find a new equilibrium. We didn't see that. We saw a limit down. On the MCX, on the COMEX, trading halted. The circuit breakers tripped. 9% down. Halt. Open. 12% down. Halt. Open. 15%. Do you know what happens during a halt? Panic. Absolute blind panic. Because you can't get out. You're watching your net worth evaporate and the sell button is grayed out. It creates a psychological break. It forces you to make irrational decisions the second the market reopens. You scream, just get me out at any price. And that is the trap. That moment right there, when the retail trader, the guy with 2 contracts, the small family office screams, get me out, that is the liquidity the big boys were waiting for. Because look at the volume profile on Tuesday. This is the part that makes me sit up straight. Right at the bottom, right when the despair was at its peak, right when the price touched that $78 level, the volume didn't vanish. It exploded. Someone was there. Someone was standing with a bucket, catching every single contract that you were forced to vomit up. If silver is such a bad asset, if the bubble has burst, why was there record-breaking buy volume at the exact moment of maximum pain? Who steps in front of a falling knife that is down 30% in 2 days unless they know it has hit the floor? And then, just as quickly as it fell, it ripped. I'm looking at the chart right now. It's a V-shape. It's violent. Silver didn't just stabilize. It rocketed back up 12% in a single session. It reclaimed $86 like it was nothing. That bounce, that specific violent rejection of the lows, that is not retail buying. Retail is dead. Retail is licking its wounds. Retail is on the phone with their broker trying to figure out if they still have an account. That bounce is institutional accumulation. It means the flush is over. The weak hands, and I hate using that term because it sounds derogatory, but in this context, it just means undercapitalized hands, are gone. The leverage has been washed out. The open interest has been reset. And now the asset is in stronger hands. Hands that don't get margin calls. Hands that set the margin calls. This brings me to the uncomfortable part, the part about the system itself. We have to talk about the why. Why now? Why, when silver was finally breaking out, finally doing what all the macro data said it should do, did we get hit with a margin hike and a limit down flush? There is a theory, and I want to be careful here because I don't like conspiracy, I like probability, but there is a high probability that the clearinghouses were looking at a systemic problem. If silver kept going, if it hit 150, 200, the short positions held by the bullion banks would have become insolvent. We know they are short. The COT reports tell us they are net short. They have been fighting this rise for months. A 36% margin hike doesn't just hurt you, it saves them. It creates the liquidity they need to cover. It forces you to sell to them at a discount so they can close their losing bets without bankrupting the exchange. It's a transfer of liability. You took the loss so the system could stay solvent. I want you to look at one more number before we go deeper into the mechanism. Look at the spread between the paper price, the futures price that crashed, and the physical price. Did the price of physical coins drop 30% at your local dealer on Monday? Did the premiums vanish? Or did the dealers just stop selling? I called 3 dealers this morning. 2 of them told me they had system issues and couldn't book orders during the crash. The third one said his premiums went up to offset the paper drop. So the paper price crashed, but the real metal was unavailable. Does that sound like a bear market to you? Or does that sound like a disconnect? We are seeing a bifurcation. The screen price is becoming a weapon, and if you are trading the screen without understanding who controls the buttons, you are walking into a minefield. But there is something else happening in the background, something quiet that suggests this flush wasn't just about saving the shorts. It might be about positioning for what comes next. Because if you look at the currency markets, if you look at what the yen is doing while silver was crashing, you start to see a correlation that shouldn't exist. And this is where the story gets darker. This isn't just about silver. This is about the collateral plumbing of the entire financial system. I need to show you the mechanism they used, not the margin hike. That was the trigger. I mean the trap itself, how they used the limit down rules to freeze you in place while they moved the furniture. It's technical, but you need to understand it because they're going to do it again. Here is the mechanism, and it's not complex, which makes it even more dangerous. Most people think a trading halt or a limit down is a safety feature. The exchange tells you it's a circuit breaker to cool off the market, to let information disseminate so everyone can make rational decisions. That is the brochure version. In reality, a trading halt is an emotion amplifier. Imagine you're in that burning building again. The alarm is screaming. You run to the door. It's locked. You don't calm down. You panic harder. You start banging on the glass. You scream, "I don't care about the price. Just get me out." That is exactly what happens in the order book during a halt. When the market freezes, the selling doesn't stop. The execution stops. But the intent to sell builds up like water behind the dam. Retail traders, algos, and risk managers are all entering market on open sell orders. They're blindly agreeing to accept whatever price is available the second the door unlocks. But while you are entering blind sell orders, the institutions, the ones with the deep pockets, the ones who likely knew the margin hike was coming, are doing something different. They aren't panicking. They're placing limit buy orders. They're setting a floor. They're saying, "I will buy everything you have, but only at $78. So when the market reopens, bang, the dam breaks. All your panic selling hits the market at once. It smashes through the thin order book and hits their limit wall. You get filled at the absolute bottom. You lost 30%. They just acquired your position at a 30% discount. And 5 minutes later, the pressure is gone. The sellers are flushed. The price floats back up. This isn't a theory. We saw it. The V-shaped recovery on the chart is the mathematical proof of this transfer. If the selling was real, if it was based on a fundamental belief that silver is worthless, the price would have stayed down. It wouldn't have ripped 12% in a straight line the moment the retail flush was done. But here's where the story gets more complicated. And this is the signal most people are ignoring because they're too busy looking at the red candles. You need to look at open interest. Usually in a crash, open interest collapses. People leave the casino. They close their bets and go home. The table empties. But look at the preliminary data for the silver contracts. Did the table empty, or did the players just change seats? We're seeing volume that suggests the open interest didn't just vanish, it rotated. The shorts, the people betting against silver, covered their positions into your panic selling. They used your fear to exit their dangerous bets, and at the same time, new longs entered. This is a reset. The market was too heavy. Too many people were long on leverage. The bus was too full to go up the hill, so they stopped the bus, kicked everyone off, and now the bus is light enough to move again. I call this the 48-hour flush. It's a classic institutional playbook. They can't move the price up when retail is holding all the contracts because retail is weak. Retail will sell at the first sign of profit. They need retail out so they can take the price to where it needs to go without the volatility of weak hands. But, and this is critical, I need to stop for a second, because there is a scenario where I am wrong, and if you are putting your capital into this, you need to hear this part clearly. I am building a case that this was a mechanical flush, a trap to steal shares, but there is a version of this story where the market is telling us the truth. What if the margin hike wasn't a trick? What if the CME raised margins because they see something in the real economy that we are missing? If we are heading into a massive deflationary bust, a real 2008-style liquidity crisis where cash is the only thing that matters, then silver should crash. In a liquidity crisis, you sell what you can, not what you want. If big funds are blowing up somewhere else, maybe in commercial real estate, maybe in the bond market, they might be selling their silver winners to pay for their losers. If that is happening, then $78 wasn't the bottom, it was a pit stop. If we see industrial demand, solar, electronics, EVs, actually fall off a cliff next week, then this flush theory is garbage. This would be the start of a bear market, not a bear trap. I don't believe that is the case because of the V-shaped recovery, but you have to keep that possibility in your head. You cannot fall in love with your thesis. The moment I see open interest collapsing along with price, I will change my mind. But right now, the data doesn't show that. So let's assume the flush theory is correct. What were they distracting you from? While everyone was staring at the price of silver futures crashing, did you notice what happened to the spread? The spread is the difference between the paper price, the futures contract, and the physical price, the actual metal. Historically, when paper price drops, physical price drops. They move together. But in the last 48 hours, we saw a dislocation. The paper price went limit down, but try to buy a monster box of Eagles or a 100-ounce bar at that limit down price. You couldn't. The premiums didn't drop. In some places, they went up. This is the signal. This is the divergence. When the paper market and the physical market disconnect, trust the physical market. The paper market is a derivative. It's a bet on the price. The physical market is the price. If the paper price says silver is cheap, but the physical dealers say we have no silver at that price, then the paper price is a lie. It is a mispricing. And mispricing is always resolved violently to the upside. So what we have here is a bifurcation, a split reality. On one side, you have the leveraged paper traders who just got wiped out. They're angry, they're broke, they're screaming manipulation. On the other side, you have the physical buyers and the unleveraged institutions who just used that paper crash to accumulate real ounces at a discount. They aren't angry, they're quiet. And that silence is deafening. Why aren't the big banks issuing sell ratings right now? Why aren't we seeing reports about a glut of silver? Because they are busy buying. We're standing at a very specific point in time, a binary point. We have just witnessed one of the most violent washouts in the history of the metal, a 30+% intraday swing, margin hikes, limit downs, panic. Now the dust is settling. The price is hovering back around $86. The volatility is compressing. This is the calm. And we have two paths forward from here. Path one, the deflationary spiral. The crash was real, the recovery was a dead cat bounce, the economy is imploding, and silver is going to 50. If this happens, we will see it in the volume next week. It will dry up. The buyers will vanish. Path 2, the slingshot. The crash was engineered. The leverage is gone. The shorts have covered. The weak hands are out. And now there's no one left to sell. The only direction left is up. And because the overhang of retail sellers is gone, the move up won't be a grind. It will be a vertical repricing. I am watching one specific indicator to tell me which path we are on. It's not the price. The price is a liar right now. I am watching the lease rates. If the lease rates for silver, the cost to borrow the physical metal in London, start to rise while the price is stable, it means there's a shortage of metal. It means the banks are scrambling to find physical bars to settle these contracts. If I see lease rates spike in the next 48 hours, then we know. We know the paper crash was a smokescreen for a physical shortage. And if that's the case, $86 isn't the recovery. $86 is the launch pad. This brings us to the climax, because if the system is truly short physical metal and they just used their last nuclear option, the margin hike, to try and shake it loose and it didn't work, if the price is already back to where it started, then they are out of ammo. And when a central planner runs out of ammo, the market doesn't just correct, it exacts revenge. I want to map out exactly what that looks like in the next few days, because if you're holding or if you're thinking about buying this dip, you need a playbook. You can't just hope, you need a trigger. Here is what I'm watching for the rest of the week. If the margin hike was their weapon and the limit down flush was the trap, then what we're seeing right now, this stubborn grinding recovery back above $86, is the failure of that weapon. Think about it. The exchange deployed the nuclear option. They raised the cost of doing business by 36% overnight. They forced a liquidation event that should have broken the back of this bull market for months. And yet, 48 hours later, here we are. The price is back. The structure is repaired. The V-shape is complete. This tells me one thing. The underlying demand for silver is stronger than the mechanism designed to suppress it. If they fired their biggest shot and the market just shrugged it off, what do they have left? That is the question that should keep the shorts awake tonight. Because if you are short this market, if you're a bullion bank or a hedge fund betting on a collapse, and you just watch the price absorb a margin shock and keep rising, you know you're in trouble. You know the easy money on the short side is gone. So here is the playbook for the next few days. This is exactly what I am watching, and more importantly, what I am not doing. First, I am watching the $86 level. This is the battlefield. This is where the fight is happening. If we can close the week above 86, it confirms that the flush was a bear trap. It means the buyers who stepped in at 78 are defending their position. They are now the floor. If we break $90, that is the signal. That is the all clear. A break above 90 invalidates the entire crash. It tells the algos that the path of least resistance is up, and we could see a squeeze that makes Monday look like a warm-up. But, and this is critical, I am not chasing this with leverage. That is exactly what they want you to do. They want you to get confident. They want you to load up on futures contracts again so they can rinse you with another margin hike next week. I am not playing their game. I am not trading the paper noise. I am looking at this as a stress test for the physical market. The system just shook violently and nothing broke. The metal didn't flood back into the vault. The premiums didn't collapse. This reinforces my core thesis. We are moving from a price-driven market to a possession-driven market. In a price-driven market, you care about the ticks on the screen. In a possession-driven market, you care about having the asset when the music stops. And Monday showed us that when the music stops, the screen goes dark. The sell button disappears. The only thing that matters is what you actually own. So my strategy remains boring. It remains stubbornly simple. I am holding. I am not selling into the panic, and I am not leveraging into the recovery. I am letting the institutions fight each other. Let JP Morgan fight the shorter-term funds. Let the Shanghai traders fight the London fix. I will sit here with a physical position watching the lease rates. If those lease rates start to climb, if the cost to borrow metal spikes while the price is trying to recover, then we know the truth. We know that the vaults are tighter than they are admitting. Monday was a warning shot. It was a reminder that the rules can change instantly. Margins can rise, limits can hit, trading can halt. But it was also a gift. It showed us where the real demand is. It showed us that at $78, there are billions of dollars of capital waiting to buy. That is a floor. That is a concrete foundation that wasn't there last week. We know where the bottom is. Now, they showed it to us. The question you have to ask yourself, the binary question that decides your next move, is this. Do you believe the 30% crash was the market realizing silver is worthless, or do you believe it was the market resetting the table for a much larger move? I know where I stand. The volume doesn't lie. The recovery doesn't lie. The price was fake. The panic was real. And the rebound? That's the only part of this story that makes sense. I'll be watching the close on Friday. If we are above 86, the trap failed. And if the trap failed, the hunters are about to become the hunted. Stay safe out there. Don't use leverage. Watch the spreads. I'll see you in the next one. It's the wick on the Tuesday candle